Silver and gold. Are these metals terrible investments? Well, by many standards, they are. There are some significant downsides to purchasing and stacking physical precious metals. And I want to go over those in today's video and talk about some of the risks that you take on when you stack gold and silver. But, if you still want to buy some gold and silver after I get done with this list, make sure you check out today's video sponsor, sdbullion.com. Right now, new customers can get gold or silver at spot by visiting sdbullion.com/new. So let's get right into the downsides here of stacking physical gold and silver. First of all, what are these metals? They're just minerals, right? They're inert metals. You dig them up out of the ground, you refine them, and then you stick them in a safe somewhere. They don't produce anything. There's no human creativity or ingenuity or productive enterprise associated with these. They have no yield. They don't pay a dividend. They don't produce profits. They don't produce earnings. So you might say that when you stack gold and silver, there is a significant opportunity cost. You could have taken that money and you could have bought, say, stocks or bonds or something that pays you to hold it, because gold and silver, they don't do that. There's no yield associated with them. Another problem with physical metals is the price of gold and silver. It's volatile. We just witnessed that this past Sunday. Gold overnight, it spiked up to a record high of $21.50 per ounce, around there. And then overnight, the price was smacked down more than $100. Right now, we're sitting under $2,050 in the spot price of gold. So there can be significant volatility there. And if you think gold is volatile, well, silver is even more so. It's a much smaller market, and so the swings there tend to be much bigger. So really, gold and silver are not for the faint of heart. If you don't like sitting on an asset that's going to have significant swings in valuation one way or the other, then gold and silver might not be for you. In addition to the fact that there's no yield on these metals, there's actually almost sort of a negative yield, because you've got to securely store these things, whether that means paying a private vault to hold them for you or insuring them somehow. There is a cost to holding physical precious metals. They're in your own custody. You're responsible for them. So you're either taking on some significant risk or you're paying to mitigate that risk. So that is another strike against the precious metals. Premiums are another problem. If you want to actually stack physical gold or silver bullion, you're going to be paying maybe 2, 3, 5, 6, 7, 8, 9% over spot. The spot price, of course, is the paper market price for gold and silver. But if you want to get the real thing that you can hold in your hand, you're going to be paying some percentage over that. Now, the premiums, they kind of come up and they go down, but they're always present. And so, if you want to get exposure to the precious metals, why not just buy the SLV ETF or the GLD ETF? They're way more liquid. They're much easier to trade in and out of. You're not going to get hit with that high spread that you see on physical metals, because, as soon as you buy a gold bar or a silver coin, you're basically immediately at a loss as a result of that premium. And that is a significant downside, if you ask me. On top of that, you've got to look out for counterfeits. If you're not careful where you buy your gold and silver, you might end up with a product that isn't even the metal itself. It could just be a fabrication. It could be a big 100-ounce silver bar like this that's really just silver on the outside. Could be drilled out and filled with another base metal. I mean, who knows, right? You got to make sure you're dealing with trusted counterparties in the physical bullion market. And that's why I like dealing with places like SD Bullion, where at least you know what you're getting. But nonetheless, that is a significant risk. And also, that can be a problem when you go to sell your metals. It could be hard to convince whoever is buying your metals from you that they are indeed legitimate precious metals, because counterfeits are out there. So all of these are significant problems for the precious metals. And, I asked the question, are they terrible investments at the beginning of the video? But, you might even make the argument that gold and silver aren't investments at all. And that's kind of the view I take on them, that they are actually just savings. They're like a savings in real money, because you can save dollars, of course, but we know that the ultimate goal for the dollar is to devalue it. The Federal Reserve tells us that their goal is to devalue the dollar by 2% annually, and sometimes they exceed that goal significantly. So, if you want to actually store money that is a store of value, gold and silver are it. But there's a lot of problems with these things. There's opportunity costs. Historically, gold and silver have underperformed things like the S&P 500, paper assets, stocks, companies that produce valuable things that pay dividends, that put money in your pocket every month or every quarter or every year just for holding them. So, why would I stack gold and silver if they are so terrible, if there are so many problems with them as investments? Well, I will say that you do take on risk when you buy gold and silver, but there's also risk in moving into any asset class. There's risk in holding US dollars, the devaluation risk, the inflation risk, the sovereign debt risk. We've got, $33.895 trillion in debt here. And ultimately, that can only be paid off in devalued currency. So that's one reason that despite all the risks, I think it's worth holding physical metals. But also, while it has historically been somewhat risky to pick up precious metals in the sense that they underperform things and there's an opportunity cost and an opportunity risk there, it can also be very risky to buy into paper assets at too high of a valuation. And if you look at this is the Shiller PE ratio. So this is like a time-adjusted PE ratio of the stock market. And right now you'll notice that we are at a very high valuation here in stocks, in paper markets. In fact, the only times that we have been higher than we are right now in terms of this Shiller PE is immediately following the stimulus of the pandemic, the 2001 dot-com bubble, and then also the stock market bubble of the 1920s. And you can see the level we're at right now in terms of paper asset valuation is the same level we were at right before the massive stock market crash of the 1920s. And so that's one of the reasons that despite the fact that gold and silver have some downside risk associated with them, I'm still stacking them. To further illustrate this point, I want to look at this. This is the chart of the Dow to gold ratio. And so this basically tells you how many ounces of gold it would take to buy you a share of the Dow or all the stocks in the Dow Jones Industrial Average. You can see right now we are at a very high valuation. It's right around 17. And in the past, there have been two occasions over the past 100 years or so when this ratio has declined significantly. Once was in the early 1930s following that stock market crash. We saw the Dow to gold ratio get under 2. For less than 2 ounces of gold, you could buy the entire Dow. And then also in 1980, when gold spiked to what is still its inflation-adjusted all-time high following the massive inflationary decade of the 1970s. This is where Nixon took us off the gold standard and we had all that inflation. Dow to gold ratio actually went down close to 1, close to parity. And right now, you'll notice we are, again, very high. So there are good times and bad times to buy gold based on this chart. 2000 was a great time. That was a great time to sell paper assets during the dot-com bubble and buy into gold, which I think was around, $250 an ounce at the bottom. Also, if you bought around 1971 when Nixon took us off the gold standard, that was a great time to buy gold. And then these spikes down, those are good times to trade out of precious metals and into paper assets. Also, in 2011, you can see it drop down below 10. Now, it's not as extreme as those other examples, but that was a good time to unload some gold and buy into paper assets. But when you see this ratio move higher, I believe it is a good time to get into gold because typically when you see this ratio spike, it is either due to gold being undervalued, paper assets being overvalued, or a combination of the two. So while getting into precious metals in the long term, if you were to just hold one asset, yeah, they're probably going to underperform productive assets like companies that, pay a yield and that do something productive in the economy. At the same time, you don't want to buy into stock market bubbles. And if you ask me, we are in the midst of a massive bubble in paper assets right now, inflated by record low interest rates that the Fed kept low for a decade plus following the great financial crisis of 2008, by massive amounts of quantitative easing. I mean, the Fed has eased back a little bit on their quantitative easing. They've managed to sell off some of the assets on their balance sheet, but the Fed balance sheet's still well over $7 trillion. So all of that paper, all of those dollars that were pumped into the system, they inflated giant bubbles in paper assets. And yet that money really doesn't seem to have flowed into the gold and silver market yet. Sure, gold is at near all-time highs. However, if you adjust previous highs for inflation, gold's not even close to the top, and silver is not even close to its nominal all-time highs. Silver in 2011 hit $50. Right now, it's under $25 per ounce. So, yeah, gold and silver for the long term, maybe they're terrible investments. They're really safe savings, if you ask me. I mean, there's almost no other asset that, say you were to go back to Roman times, or even pre-Roman times, you go back thousands of years into history. If you wanted to have one asset that you could save over all that time that would still hold value, gold and silver are probably the only asset out there that fits that bill. But I know, that's more of just a intellectual exercise. Most people are looking for something to put their money into for maybe the next 10 years, the next 20 years. And while gold and silver do not always fit the bill for something that will pay off in that regard, I think right now is a great time to be acquiring them. Now, keep in mind, none of this is financial advice. I'm not a financial advisor. I'm just a guy on YouTube, so take all of this with a huge grain of salt. Make sure you're doing your own research. But listen, there's a lot of downsides to gold and silver, but all assets have downsides. And right now, gold and silver, relative to other investable assets, I believe these are very cheap. And why not just use the GLD or SLV? Well, in addition to being a savings account, gold and silver are sort of like an insurance policy against a sovereign debt crisis, a currency crisis, massive financial problems. And GLD and SLV, they're just not. There's probably not enough gold and silver to back up those paper assets. So if you really want the unique characteristics of physical precious metals, that being that there's no counterparty risk, you take the wealth into your own custody, they are physical, tangible, useful assets, then you need to hold the real physical metal. So that's just my take on things. Let me know what you think in the comments down below. Are gold and silver a terrible investment? Are they investments at all? I'd like to hear what you have to say. Leave me a comment to let me know. Thanks for watching, everybody. Stay safe and happy stacking, and I will catch you next time. Smart Silver Stacker, out.